Hi guys, remember in our last lesson, we talked about those $160 Apple calls can be exercised to buy each shares at $160 for 100 shares per contract. Apple is currently trading at about $170 per share, so an $160 call would be in the money. There are three types of option moneyness: in the money, at the money, and out the money. On the option chain, you will notice the color coding difference. On the call side, all the in the money calls will be strikes that are below the market price. On the put side, all the in the money puts will be strikes that are above the market price. At the money options are the strikes that are near the market prices, but not quite in the money yet. Scalpers or day traders usually take advantage of these contracts. And because these at the money options don't carry intrinsic value, only extrinsic value, these premiums increase quickly as they move into the money. Extrinsic value is your time value, which we will cover later. In the money options carry intrinsic value, so their premiums are pricier than out the money options. If you look on the option chain, the deeper the contract is in the money, the higher the price. That means the lower the strike for calls and the higher the strike for puts. Out the money options are calls with strikes higher than current market price and puts with strikes lower than the market price. Out the money contracts are just like at the money. They don't carry intrinsic value. Out the money premiums are a combination of implied volatility and time value. Swing traders use out the money contracts because they are cheap and they move faster as the strike gets closer to the market price. Options contracts primarily consist of intrinsic and extrinsic values. Of course, intrinsic value can be zero for at the money and out the money contracts. Intrinsic value is what option holder will receive if exercised. So, how do we calculate intrinsic value? For calls, you subtract strike price from the market price, and for puts, you subtract market price from the strike price. For example, an $160 call for Apple will carry $180, which is the market price when we made this video, minus $160. So $20 intrinsic value. Take a look at the table in front of you for more clarification. Now, let's cover extrinsic value. You can find out the extrinsic value from subtracting the intrinsic value from the premium. Higher IV will have higher extrinsic value, and since it is time value, the farther out your expiration, the higher your extrinsic value. Take a look at the table in front of you for some ITM and OTM extrinsic value examples. Stay tuned for our next lesson. We will talk about volatility and how it affects options.